One of the most respected and thoughtful investors of our time, Howard Marks, dedicated his career and his writing to answering this very quest. His answer, however, was as profound as it was unexpected. There is no single most important thing. Instead, successful investing requires a deep and simultaneous mastery of many different interconnected principles, each one of which is at times the most important. This is not the story of a secret formula. This is a deep dive into the mind of a modern investment philosopher. It is a masterclass on the 20 core principles that form his comprehensive framework for rational decision-making in an irrational world. These are the ideas, honed over 5 decades of navigating the markets and articulated in his legendary client memos and his classic book, The Most Important Thing, that have made him an essential read for the world's greatest investors. In this first part of our analysis, we will deconstruct the first 10 foundational ideas from his book. These are the principles that form a complete toolkit for developing superior judgment, understanding the true nature of the market, and, most critically, mastering the complex art of risk. To understand the philosopher, one must first understand his background. Howard Marks's journey began not in the frenetic speculation of a trading floor, but in the rigorous academic environment of the University of Chicago Booth School of Business. It was here, in the epicenter of efficient market theory, that he was steeped in the quantitative, evidence-based approach to finance. After graduating, he began a long and successful career in the world of high-yield bonds, convertible securities, and most notably, distressed debt. In 1995, he co-founded Oaktree Capital Management, a firm that would become one of the world's preeminent investors in these complex and often overlooked asset classes. This background is critical. Operating in the world of distressed debt, the securities of companies in or near bankruptcy, is an exercise in pure, unadulterated risk assessment. It is a field where the potential for a permanent loss of capital is ever present. This experience, far from the optimistic world of growth stock investing, forged his entire philosophy, a doctrine built not on the pursuit of upside, but on the rigorous control of the downside. His famous client memos, which he began writing in 1990, became his vehicle for exploring and articulating this philosophy, and they are the foundation for the principles we will now explore. The first most important thing: second-level thinking. This is the cornerstone of the entire Marx philosophy, the single concept that separates the average investor from the truly superior one. Marx argues that to achieve exceptional results, you cannot think like everyone else. The consensus view, what he calls first-level thinking, is simple, superficial, and easily arrived at. First-level thinking says, "This is a great company, let's buy the stock," or, "The economic outlook is negative, let's sell everything." It is a simplistic, linear approach to a complex problem. Second-level thinking is the opposite. It is deep, complex, and contrarian. The second-level thinker starts where the first-level thinker stops. Their thought process is a series of more demanding questions. The first-level thinker says, "The company's outlook is bright." The second-level thinker asks, "Yes, but how bright is the outlook compared to the consensus expectation? Is that bright outlook already reflected or more than reflected in the stock's current price? What is the range of possible outcomes and what is the probability of each? What happens to the stock if the bright outlook turns out to be merely good?" It is a process of thinking about thinking, of understanding that the price of a security reflects not just its fundamentals, but the market's collective perception of those fundamentals. To be a successful investor, one must have a view that is different from, and better than, the consensus. Marx provides a simple analogy. In a pari-mutuel betting system like horse racing, the goal is not to pick the horse that will win the race. The goal is to pick a horse whose odds of winning are greater than the odds being offered by the betting public. It is possible to lose money betting on the best horse if it is overbet, and it is possible to make a great deal of money betting on a long shot if its real chances of winning are underestimated by the crowd. The same is true in investing. The first-level thinker tries to pick the best companies. The second-level thinker tries to find the mispriced bets. This is an incredibly demanding task. It requires a great deal of work, a contrarian mindset, and the psychological fortitude to be different from the crowd, which often means looking wrong before you are proven right. But for Marx, it is the only path to superior returns. This concept of second-level thinking is a powerful tool. What is a current market situation or popular stock where you believe first-level thinking is dominant? And what would a second-level thinker's contrarian perspective be? Share your analysis in the comments. The second most important thing, understanding market efficiency. Having established the need for a superior thought process, Marx then confronts the primary obstacle, the efficiency of the market. Drawing on his academic background, he acknowledges the core truth of the efficient market hypothesis. For the most part, in the major, heavily analyzed public markets, the collective wisdom of millions of participants does a very good job of pricing assets fairly. The consensus view is often close to correct, and trying to consistently outsmart it is an incredibly difficult, and for most, a losing game. This is why the majority of active fund managers fail to outperform their passive index benchmarks over the long term. However, Marx's view is nuanced. He is not a dogmatic believer in perfect market efficiency. He argues that markets are a spectrum. Some, like the market for S&P 500 stocks, are highly efficient with thousands of brilliant analysts scrutinizing every data point. Finding an edge here is extremely difficult. But other markets, particularly the ones in which Oaktree specializes, like distressed debt or the securities of smaller, less followed companies, are significantly less efficient. There is less competition, less available information, and more room for emotional, non-rational decision-making. It is in these less efficient pockets of the market that a skilled, diligent, second-level thinker can find a durable edge. Furthermore, he argues that even the most efficient markets are not perfectly efficient all the time. They are, after all, made up of fallible human beings who are subject to waves of greed and fear. This psychology creates temporary dislocations, periods of mania or panic, where prices can become dramatically detached from intrinsic value. For Marx, the market is not a perfectly rational calculating machine. It is a dynamic, often emotional, entity. The key is to understand that beating the market is not easy, to have humility about one's own predictive abilities, but also to recognize that because of human psychology, inefficiencies do exist, and they can be exploited by a patient and disciplined investor. The third and fourth, value and the relationship between price and value. At the core of the Marx investment philosophy is a relentless focus on value. He defines investing as the process of buying an asset with a clear and well-reasoned estimate of its intrinsic value. Speculation, by contrast, is buying an asset simply because you believe its price will go up, without regard to its underlying worth. For Marx, a true investment decision must be anchored in a disciplined, analytical approach to determining what a business is fundamentally worth. This valuation process is not about arriving at a single, precise number. He believes that intrinsic value is not a hard point, but a range of probable outcomes. The goal of the analyst is to determine this range with a high degree of confidence. This leads to the fourth and critically important principle, understanding the relationship between price and value. This is the essence of the investment process. The value of an asset and the price at which it trades are two completely different things. The greatest investment errors, Marx argues, come from confusing the two. A high-quality asset is not automatically a good investment, and a low-quality asset is not automatically a bad one. The outcome is determined entirely by the price you pay. A wonderful company, if purchased at a price that already reflects a future of perfect, uninterrupted growth, can be a terrible investment. Conversely, a struggling, mediocre company, if purchased at a price that reflects a future of utter collapse, can be a wonderful investment if it simply manages to survive. The greatest opportunities for the superior investor are born from the market's failure to correctly distinguish between the two. These opportunities often arise during periods of extreme market emotion. In a panic, the market will offer up the securities of high-quality companies at prices far below their intrinsic value. In a speculative mania, it will offer the securities of unproven or mediocre companies at prices far above any rational calculation of their worth. The job of the second-level thinker is to maintain the discipline to understand the difference, to buy when the price of an asset is at a significant discount to its value, and to be skeptical when the price far exceeds it, regardless of the prevailing market sentiment. The fifth, sixth, and seventh, a deep dive into risk. No concept is more central to the Howard Marks philosophy than risk. His entire career in distressed debt was a masterclass in managing it, and his writings dedicate more space to this topic than any other. He breaks down the mastery of risk into three distinct but interconnected principles. The fifth most important thing is understanding risk. Marx's most profound contribution here is his rejection of the academic definition of risk. In modern portfolio theory, risk is defined as volatility. A stock whose price fluctuates wildly is considered riskier than one whose price is stable. Marx argues that this is a profound and dangerous error. For a long-term investor, short-term price volatility is not the real risk. The true and only definition of investment risk, in his view, is the probability of a permanent loss of capital. An investor who buys a stock that goes to zero has suffered a 100% loss, and no amount of time will ever recover that capital. That is the ultimate risk. A stock that falls 50% in a market crash but is of a fundamentally sound company will likely recover and go on to new highs. The volatility was temporary. The capital was not permanently lost. By redefining risk in this way, Marx completely changes the investor's focus. The goal is not to avoid volatility. The goal is to avoid making investments where there is a high probability that you will never get your money back. This leads to the sixth most important thing, recognizing risk. This is a deeply contrarian insight. Marx argues that the amount of risk in a market is not a function of its quality, but of the behavior of its participants. Paradoxically, risk is lowest when the perception of risk is highest. At the bottom of a market crash, when fear is pervasive, asset prices are low, and investors are terrified, the actual risk of a permanent capital loss is at its lowest point. Conversely, risk is highest when the perception of risk is lowest. At the peak of a euphoric bull market, when prices are high, greed is rampant, and investors believe that there is no risk. The actual probability of a future capital loss is at its absolute maximum. Recognizing risk, therefore, is not about looking at charts. It is about gauging market sentiment. When everyone is confident and aggressive, the superior investor becomes cautious. When everyone is fearful and selling, the superior investor becomes aggressive. This brings us to the seventh most important thing, controlling risk. If risk is the probability of a permanent loss, how does one control it? Marx is clear that it is not controlled by avoiding it entirely. Investing is the act of intelligently bearing risk for profit. Risk control is achieved not by buying safe assets, but by buying any asset, no matter how speculative it may appear, for a price that is low enough to provide a substantial margin of safety. The disciplined insistence on buying at a discount to intrinsic value is the only reliable way to control risk. Even if a company's fortunes decline, if you bought it for 50 cents on the dollar, your chances of a permanent capital loss are dramatically reduced. For Marx, risk control is not a secondary activity. It is the absolute center of the entire investment process. This sophisticated, multi-layered understanding of risk is what separates the world's greatest investors from the rest. It is not a lesson learned once, but a mental discipline cultivated over a lifetime. To continue developing this professional-grade framework for thought and to learn the habits of the market's master operators, we invite you to subscribe to this channel and join our community of serious market participants. The eighth, being attentive to cycles. This principle is another cornerstone of the Oaktree philosophy. Marx believes that cycles are one of the most reliable and fundamental features of the financial world. Nothing goes in one direction forever. There is the economic cycle, the corporate profit cycle, the credit cycle, and the psychological or sentiment cycle. These cycles are not perfectly predictable in their timing or magnitude, but their existence is a dependable reality. The great error of most investors is to extrapolate the recent past into the indefinite future. In a boom, they believe the good times will last forever. In a bust, they believe things will never recover. The superior investor understands that these cycles are real, and that the most important thing is not to predict their exact turning points, but to have a clear sense of where we are in the current cycle. Knowing where we stand allows the investor to tilt their portfolio accordingly. The ninth, awareness of the pendulum. If cycles describe the broad, multi-year movements of the market, the pendulum is Marx's brilliant metaphor for the short to medium-term swings in market psychology. He writes that the market is like a pendulum, constantly swinging between two extremes: euphoria on one side and depression on the other. It swings from a point where the outlook is perceived as flawless and risk is non-existent, to a point where the outlook is perceived as hopeless and risk is seen everywhere. The crucial insight is that the pendulum spends very little of its time at the happy medium, the rational center. Its natural tendency is to swing toward and through the extremes. The job of the investor is not to predict the exact arc of the swing, but simply to recognize where the pendulum is at any given moment. This awareness is the key to contrarian behavior. When the pendulum is at the extreme of euphoria, the investor should be at their most skeptical and defensive. When the pendulum is at the extreme of depression, the investor should be at their most aggressive and opportunistic. The 10th, combating negative influences. This final principle for our first part is a deep dive into the psychological biases that drive the pendulum's swing. Marx is a master student of investor psychology, and he identifies several key negative influences that the superior investor must actively combat. The most powerful of these are greed and fear. Greed is the force that causes investors to abandon their discipline and buy into speculative manias, terrified of being left behind. Fear is the force that causes investors to panic and sell their holdings at the bottom of a crash, locking in permanent losses. He also identifies the suspension of disbelief, the tendency for investors in a bull market to willingly abandon their skepticism and embrace new era narratives that justify absurd valuations. Another is the tendency to capitulate, where after a long period of pain or being wrong, an investor finally gives up and joins the herd, often at the exact point of maximum reversal. For Marx, the battle for superior returns is largely an internal one. It is a constant fight against these powerful, innate, and destructive psychological influences. These first 10 principles provide a complete philosophical toolkit for understanding the market, assessing risk, and thinking with superior judgment. But how does an investor translate this deep understanding into a practical working portfolio? That is the subject of the final 10 principles, where we move from the world of philosophy to the art of the operator. The 11th, Contrarianism. Having established the importance of second-level thinking, the next logical step in the Marx philosophy is the practice of contrarianism. For Marx, this is not a simple reflexive act of doing the opposite of whatever the crowd is doing. That, he would argue, is just another form of first-level thinking. True, successful contrarianism is a two-step process. The first step is to accurately identify the prevailing consensus view. The second, and far more difficult step, is to determine why that consensus is wrong. A contrarian position is only a good investment if your variant perception is more correct than the market's. The entire opportunity for superior returns is predicated on this idea. The market, in its collective wisdom, does a reasonably good job of pricing assets. For an investor to outperform the market, they must hold a portfolio that is meaningfully different from the market. And for that different portfolio to perform better, the investor's view on which assets are mispriced must be more accurate than the collective view. As Marx writes, You can't do the same things others do and expect to outperform. Therefore, contrarianism is not an option for the superior investor. It is a necessity. The logic is simple. The greatest profits are not made by buying what everyone likes. By the time an asset is popular, its price already reflects the widespread optimism, and its potential for future returns is therefore muted. The greatest opportunities are found in the assets that the crowd has overlooked, misunderstood, or most profitably, despises. This requires the psychological fortitude to buy when everyone else is selling, and to sell when everyone else is buying. It is an inherently lonely and uncomfortable activity. As he notes, the consensus is wrong often enough to make contrarianism profitable. The successful contrarian must have the analytical skill to identify a flawed consensus and the emotional strength to bet against it, often looking wrong for a period before the market eventually comes around to their point of view. The 12th, finding bargains. If contrarianism is the general posture, then finding bargains is the specific activity. This is the practical day-to-day work of an Oaktree investor. Marx is clear that Oaktree's strategy is not about buying good companies, but about making good buys. The world is full of good companies whose stocks are terrible investments because their prices are too high. A true bargain is an asset that is priced significantly below its intrinsic value. So, where do these bargains come from? Marx argues that they are rarely found in the calm, efficient, and well-lit corners of the market. They are found in the dark, messy, and inefficient niches. This is why Oaktree has always specialized in less trafficked areas like distressed debt, where the analysis is complex and the emotional backdrop is one of extreme fear. He has a clear recipe for what creates a bargain. The first ingredient is an asset that is out of favor or misunderstood by the broader market. The second is a seller who is highly motivated or even forced to sell. A forced seller is an institution or individual who must liquidate an asset, not because they believe its price is too high, but due to external pressures. This could be a mutual fund facing massive redemptions, a bank forced to sell a security due to a regulatory change, or a panicked individual investor receiving a margin call. In these situations, the seller is not price sensitive. They are time sensitive. They need liquidity now, and they are willing to sell at almost any price to get it. The strategy of Oaktree is to be the calm, rational, and highly liquid buyer on the other side of that forced selling. They are providing liquidity to the fearful, and in return, they are demanding a bargain price. The 13th, patient opportunism. This principle describes the necessary mindset for a bargain hunter. Since true bargains are, by their nature, rare, the investor must be prepared to wait. This is the concept of patient opportunism. Marx believes that the greatest enemy of the investor is the need for constant action, the feeling that capital must always be put to work. This activity bias leads to what he calls deal flow, the pressure to constantly buy something, which inevitably leads to buying mediocre assets at fair prices. The Oaktree approach is the opposite. They believe that superior investing is not about how many good investments you make, but about how few bad investments you make. Their process is one of patient, disciplined waiting. They conduct their rigorous, second-level analysis. They know what they are looking for, and then they wait for the market to come to them. This can mean holding significant amounts of cash for long periods, sometimes for years, while a bull market is raging. This is an incredibly difficult discipline. It requires resisting the powerful psychological pull of envy and the fear of missing out. But for Marx, this patience is a strategic necessity. He knows that market cycles will inevitably create periods of turmoil and panic, and it is during these periods that the greatest bargains will appear. The investor who has patiently preserved their capital, their dry powder, during the good times, is the one who will have the resources to act decisively and aggressively when the market is in crisis and assets are cheap. Cash, in his view, is not a dead asset. It is the raw material for seizing opportunity. The 14th, knowing what you don't know. This is Marx's version of the circle of competence, a principle of profound intellectual humility. He is adamant that the future is not knowable. The world is a complex, chaotic, and fundamentally unpredictable place. Therefore, any investment approach that relies on a single, precise forecast of the future is destined to fail. He writes, "We have two classes of people who forecast, those who don't know and those who don't know they don't know." He places himself firmly in the first category. The goal of a superior investor is not to have a crystal ball. The goal is to have a keen understanding of the limits of one's own knowledge. It is about being brutally honest with yourself about what you can and cannot predict. For Marx, this means his approach is highly probabilistic. Instead of making a single forecast, he thinks in terms of a range of possible outcomes and tries to assign probabilities to each one. His goal is to build a portfolio that will generate a reasonable return under a wide variety of future scenarios, and that will survive, if not thrive, in the case of a negative, unexpected outcome. The greatest investment danger lies with the investor who is supremely confident in their singular view of the future. This overconfidence leads to highly concentrated, leveraged bets that can be wiped out by a single, unforeseen event. Marx's entire philosophy is a defense against this kind of hubris. It is the discipline of saying, "I don't know," and then building a portfolio that accounts for that fundamental uncertainty. The 15th. Having a sense of where we stand. This principle is the practical application of his deep understanding of cycles. If the future is not knowable, how can an investor make intelligent decisions? Marx's answer is that while we cannot predict when a cycle will turn, we can make a reasonably accurate assessment of where we are in the present cycle. This sense of positioning is, for him, one of the most important things an investor can have. He is constantly asking a series of diagnostic questions. In the economic cycle, are we in the early stages of a recovery, the mid-stage of a stable expansion, or the late stages of an overheated boom? In the credit cycle, which he considers to be even more important, are lenders eager and willing to finance any project, or are they fearful, risk-averse, and demanding restrictive terms? In the sentiment cycle, is the market pendulum at the extreme of euphoria, where investors believe risk is non-existent, or is it at the extreme of despair, where investors believe the risk is infinite? The answers to these questions do not allow Oaktree to time the market perfectly, but they do allow them to tilt their portfolio's posture. When their analysis suggests that the cycles are in a favorable position, the economy is recovering, credit is available, and sentiment is still skeptical, they will move their portfolio to a more aggressive posture, taking on more risk in the pursuit of higher returns. Conversely, when their analysis suggests that the cycles are in a dangerous position, the economy is overheating, credit is tightening, and sentiment is euphoric, they will shift to an extremely cautious and defensive posture, selling assets, reducing risk, and raising cash. This is not market timing. It is a logical, strategic adjustment based on an objective assessment of the current environment. The 16th and 17th. Appreciating the role of luck and investing defensively. These two principles are at the heart of his risk management philosophy. Marx has a deep appreciation for the role that randomness or luck plays in investment outcomes. In a complex system like the market, the connection between the quality of a decision and the quality of its outcome is not always direct. A good decision can lead to a bad outcome if bad luck intervenes. A bad decision can lead to a good outcome through pure, dumb luck. The superior investor understands this. They know that they cannot control the outcome, but they can control their process. They focus on making decisions that have a high probability of success over the long run, and they refuse to be fooled by the randomness of short-term results. This humility is the source of his second principle, investing defensively. He contrasts two types of investing styles. An offensive investor is focused on hitting home runs, making aggressive, concentrated bets in the hope of generating spectacular returns. A defensive investor, on the other hand, is primarily focused on avoiding strikeouts, on not losing money. Marx is firmly in the defensive camp. His goal is not to have the best performing portfolio in any given bull market year. His goal is to have a portfolio that generates good, consistent returns over a full market cycle, with a much lower probability of a major, catastrophic loss during a downturn. His philosophy is encapsulated in the old saying, "If we avoid the losers, the winners will take care of themselves." This defensive posture is achieved by consistently insisting on a margin of safety, by avoiding leverage, and by refusing to make investments that depend on a single rosy forecast of the future coming true. The 18th, 19th, and 20th most. Avoiding pitfalls, adding value, and putting it all together. The final principles in his book are a summation of his practical wisdom. The 18th, Avoiding Pitfalls, is a deep dive into the specific analytical and psychological errors that trip up most investors. These include the tendency to extrapolate recent trends into the future indefinitely, the illusion of control that comes from believing one's forecasts are accurate, and the failure to recognize the emotional extremes of the market pendulum. The 19th, Adding Value, is his reflection on what an investment manager's true purpose is. It is not simply to ride the market's beta, but to generate superior risk-adjusted returns, or alpha, through the consistent application of a superior process. This alpha, he argues, comes from the things we have discussed: superior second-level thinking, a greater understanding of market cycles, and a more disciplined control of one's own psychology. The final 20th principle is putting it all together. Marx emphasizes that none of these most important things exists in a vacuum. They are all interconnected parts of a single holistic philosophy. A superior investor must be able to hold all of these concepts in their mind simultaneously, using them as a multi-layered checklist to guide every single investment decision. It is the combination of all these elements applied with discipline and consistency over a long career that leads to superior long-term results. In conclusion, the wisdom of Howard Marks is a powerful antidote to the short-term, hype-driven, and often irrational culture of modern finance. His legacy is that of a great teacher, an investor who, through his memos and his book, has provided a generation of market participants with a complete and coherent framework for rational, risk-averse, and contrarian thinking. His philosophy is not a system for generating quick profits. It is a timeless guide to the art of superior judgment. It is a reminder that the key to long-term survival and success is not in predicting the future, but in understanding the present, controlling risk, and navigating the timeless cycles of the market and the human mind. As a final recommendation for any serious market student, it is valuable to study the raw psychology of speculation, as it is the foundation upon which all market movements are built. The foundational text in this area remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. The main character, Larry Livingston, is the prototype of Jesse Livermore. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below.